How's it going, everyone? My name is Amos, and in this video, I'm going to be walking you through my thought process and rationale as to how I reached the conclusion of giving the grade that I did for the video that I made about ranking and grading the Mag 7 and other popular stocks. So without further ado, let's go ahead and get into it. The first company is going to be Apple, and the grade that I ultimately gave them was an A-. Now, there's nothing wrong with them, but their numbers have really slowed down in the past couple of years. They're facing aggressive competition from the Korean and Chinese smartphone makers, but Apple is not just sitting on their butts and saying, what are we gonna do? They're being proactive because they're making a hard pivot into fighting Netflix in the streaming wars. What I have heard is that Apple TV is really freaking good. The production quality and the shows and the content that's available, I wouldn't know, but I've heard that it's really good. And it's the official sponsor and digital platform for the MLS, Major League Soccer. Yes, I'm an American. And they're also finding steady growth in the services arm of their business. So the Apple Care plan, and that also includes the App Store, Apple Music, iCloud, and Apple Pay and the Apple Credit Card. And as you can see on your screen right now, their financials, it's starting to slow down, right? As of right now, $400 billion of revenue. That is really freaking fantastic. However, from the year prior, it only, in parentheses, right, only grew by 4.9%, because the rest of the Mag 7, they're growing their revenue year over year at a double-digit pace. So Apple, things are looking kind of sluggish for them. And as we jump on down over to their dividend profile, I mean, a 0.5% dividend yield, not too crazy, but I think the rest of the Mag 7, they're all pretty much in the same ballpark. But this is what I don't really like. Their dividend growth rate, they can absolutely afford to increase the dividend by more, but they choose not to. They're playing it safe, they're playing it conservative, and I get that, but their free cash flow per share, I mean, take a look at this, okay? $6.48. That's how much excess cash they have on hand after paying for all the operations, overhead costs, all of the employees' salaries. That's what they have left over. And the dividends paid out is $1.04. You're telling me that we can't have the financial means to increase the dividend by more than 4% a year over year? Just get out of here. But on the other side of the argument, a positive, their CAGR, the compound annual growth rate, taking into account the share price appreciation plus the dividends paid out, how much does your money grow year over year? Just shy of 30%. That's really fantastic. And I think that's why it's really hard to categorize Apple anything less than an A or S tier. You can go back and forth between which one it is, but for me, I think holistically and more realistically, it's an A-, because it does seem like their empire and the steam and the engine is starting to slow down. However, do I see them becoming obsolete? Do I see them disappearing? Do I see Samsung or Google overlapping them and having a bigger market share and the sex appeal and the status symbol, the phone that you need to have in your hands? Absolutely not. And to further that cause, when I think about Apple's economic moat, once you become a part of Apple's ecosystem, including their MacBook, iPad, or iPhone, it's so hard to jump ship or to integrate a PC or an Android product into that ecosystem. As a matter of fact, it's really unfriendly. Now, I'm a guy that uses both. I use Apple and Windows and Android and PC, mix and match, and I'm pretty much a hybrid kind of a user. Whatever is best, that's what I go with. And I'll tell you this, Apple makes it a pain in the ass to integrate or to use anything that is not an Apple product with them. Even just transferring files back and forth is a headache. But all that to say, I think their intrinsic valuation, the true inherent worth of this company as of right now in the next 365 days, should be around $218 a share. And right now, they're trading for about $205, $210 a share, depending on when you watch this. They're right around near their intrinsic valuation. So in terms of would I buy into them right now? That's a no. I don't think it's a good deal. I don't think it's a good bargain. And speaking of bargain, what is a good price with a margin of safety baked in and a risk-adjusted price to buy into Apple? For me, I think I wouldn't mind dollar cost averaging into them if they hit about $170 a share. Now, the next Mag 7 stock we're going to talk about is Nvidia. Dude, I feel like a pimple coming on in my forehead right here. Is it red? Is it irritated? But anyways, when it comes to Nvidia, I truly do not think they are a buy and hold. I know that's a very controversial take given their explosive growth in the stock market in the last 3 years. But that's because I think the semiconductor chip space is continuously evolving. That's paraphrasing paraphrasing the words from Lisa Su, the CEO of AMD. So even though right now Nvidia might be the hottest thing on the block and they have the throne and they're the king of the AI movement with their CUDA framework, in the future, it could possibly be Intel or even AMD. Okay, I'm kidding because Intel could never compete. However, on paper, looking at Nvidia's numbers, I was blown away. I mean, this is really impressive because when you look at their top line, their gross sales, it's growing at 86% year over year. Like when you think about a fundamentally sound business operation, I think what you want to see in a perfect world is a high single-digit number, right? At least like an 8 or 9% year over year. And I would chalk that up as a very successful business. But to see an 86% growth fueled by the AI movement is pretty impressive, okay? To say the least. And as we take a look at their free cash flow growth, dude, it gets even bonkers, 169% year over year. Because in comparison, that's why I like the way that I formatted my spreadsheet. If we look at it side by side, I mean, look at Nvidia's numbers, right? 169% growth in their free cash flow per share. And Apple, things are slowing down, 2.8% growth. It's pretty crazy. Now, Nvidia, I guess copying the playbook from Apple, they're being really stingy and frugal with their dividends because their free cash flow per share is $2.91. So you're telling me they don't have the financial means to increase this dividend payout by more than a 0% dividend growth rate? I mean, come on. But I get it. I think it's because Nvidia is using all of their capital and excess cash on hand in order to further innovate and design the next greatest and hottest AI chip. So I get it. But they could at least grow and raise the dividend. But I think it's a moot point because, I mean, the dividend yield is a 0.03%. You're hardly getting any dividends from this. You buy into Nvidia for their total return because the CAGR is 38%. And I think that's absolutely crazy. So you might be a little confused as to why I gave them a 90 to their economic mode instead of 100. And that's because I think AMD is carving out space and is taking market share away from Nvidia. It's like that pesky, annoying little sibling. But as an investor of AMD and Nvidia, I would argue Nvidia is best in class. But I think AMD has a bigger ceiling, if that makes sense. More growth, potential growth. And what you see right here is the intrinsic valuation for Nvidia and my personal buy price for them. And they are overall an S-. The next Mag 7 company that we're going to be talking about is Microsoft. Okay, it's a $3.5 trillion market cap. Pretty similar to Nvidia, except Microsoft is posting $270 billion of revenue. Now, what's interesting about Microsoft is even 20 years ago, they weren't considered a very sexy stock at all. It's very similar to Cisco today, because from 2005 to 2014, Microsoft was a really boring stock that didn't move much at all. Very sluggish growth, okay? However, just like IBM, another ancient technology company, a winning company will always find a way to keep growing and expanding and reinventing themselves in order to be relevant in the modern age. And as such, in the past 7 years, I would argue that Microsoft has just been aggressively growing their financials because of their pivot into the cloud movement. I think this is going to sound crazy, okay? There's not many buy and hold forever stocks in the stock market because for the most part, even if a company is very high quality and they're operationally sound, they might only be relevant for the next 5 years because the landscape of their industry is continuously changing. Case in point, Nvidia. However, the buy and hold forever stocks, when I think about it, it's business models that are relevant today and relevant 50 years from now and will be crushing it because of their economic mode, their business, or their service. And when I think about that, I think Microsoft is one of the few. I think there's no more than 100 to 125 stocks in total that are buy and hold forevers. And Microsoft is a part of that category, in my opinion. What Microsoft is doing is something that nearly every institution, every educational system, and business operation utilizes on a day-to-day level. They're not doing anything too crazy or sexy. I mean, if you are an avid gamer of Blizzard products, and you might be like, no, they are actually sexy, but what they sell and they do, it's nothing too crazy, but it just makes sense and it prints money. cloud, office products, and a gaming division, Xbox. I mean, it's just, there's a lot to like about this company. And after reviewing their financials, I mean, it further confirmed my belief that Microsoft is a buy and hold forever. I mean, their free cash flow per share, for crying out loud, $9, give or take, right? And their dividend payout is $3. And what's crazy is when you think about their revenue growing at 14% year over year, their free cash flow per share is also growing at 16% year over year, and their dividend is also growing at a double-digit rate year over year. It's 10.58%, not 10,000% or whatever that ridiculous number was. And their CAGR, so I think context matters, right? I told you, up until like 2015, Microsoft really underperformed. And consequently, as a result, that's why their CAGR is only, I say only, 17.9% for the past 20 years. That should realistically in the next 10 years, when we go from 2015 to 2035, I think their realistic CAGR should be like 25 or 26%. Don't quote me on that, that's not financial advice, but I think their sluggish days are behind them. And when we think about the intrinsic valuation, I think they should be, in an optimistic, perfect world, about $511 a share. But more realistically, I think Microsoft, their inherent worth should be about $475 a share, which is what they're currently trading for right now. My buy price, when I was dollar cost averaging into them earlier this year, was around $389, $379, $365, and lo and behold, they did hit those prices back in April. So $360 and under, I will buy shares of Microsoft. And is it any surprise that they are an A+ type of stock? I mean, just give me an example or a reason as to believe that Microsoft is trash. If you give me a solid reason and a case, I will give you a shout out in the next upload and highlight your comment. And the next Max 7 is going to be Amazon, a $2.2 trillion market cap. And what's crazy is when we think about their price to sales ratio, theirs is the closest to a 1, right? A $650 billion revenue, growing year over year at a rate of 10%. I think it's pretty phenomenal. However, as we jump down to take a look at what's going on with their free cash flow situation, year over year decreased by 36%, right? To give some context, as of right now, Google, Microsoft, and Amazon are just pouring a lot of capital expenditures, building out the infrastructure, servers, and warehouses in order to support and reinforce what they can do with their cloud network and infrastructure. Because if you don't have the bandwidth, then you can't expand as fast as you want. And that's why I think people get it wrong. When it comes to an industry where CapEx is important in order to grow the top line, I think it makes fundamental sense. But for other people, they hear the word CapEx and literally they faint. Like a Spanish soap opera. They just faint. They're like, oh, mami, mi amor. And that's why I'm saying to you, debt, loans, they're not a scary thing. If you know how to utilize them in order to grow your business, or if you're using CapEx in the right way, I think it's a good thing. It's a future forward strategy so that your business model can stay relevant and continuously improve. If you don't do CapEx, how the hell are you supposed to magically grow? Right? So I fundamentally disagree with the people out here that are just scared or allergic to debt and all CapEx. It's not bad. All that to say, I'm absolutely bullish towards Amazon's AWS, and I absolutely think they have a wide economic moat, to the point where I think truly they are a monopoly. They have a monopolistic personality. I mean, think about it. Their network effects, their cost advantages, their supply chain network of distribution centers and fulfillment centers, dude, you just can't compete with them. They're intangible assets and switching costs. Like once you set up your entire server and your system with AWS, it's so hard to pivot. And that's why when it comes to their CAGR, it makes absolute sense. 27% year over year. Economic moat, I had to give them a score of 100. And here's what's crazy, okay? I think their intrinsic valuation is $244 a share. And I kept saying, if they reach 170 a share, I might start dollar cost averaging. And the sad thing is, when they did reach 170 and then 160 and even 150 a share, I couldn't because I was buying up the other ones like Microsoft and some other stocks. But Amazon is a stock that I wish I had in my portfolio, but I don't. And the funny thing is, I don't like them as a business and as a company, but I think they look really pretty as an investment choice. Obviously an S tier. And that's why, friends and family, you should have some passive income. That way, when there is a buying opportunity and you don't have capital on hand, you can use some of the dividends that are pouring in to buy new stocks. For me, I have limited capital, so I do need to sell stuff in order to buy companies. And unfortunately, with the dividends that were pouring in, I was utilizing them to buy other shares. I feel like Amazon was number 7 or 8 on my list, and I had to just go down the priority of buying shares of stock 1, stock 2, stock 3, and I just ran out of gunpowder by the time I got to Amazon. That's just a sad reality. That's why I'm saying to you right now, don't be surprised if you run into my OnlyFans account and you see photos of my feet or belly button. I'm trying to raise that passive income, okay? Okay, jokes aside, I don't do that, you pervert. The next one is gonna be Tesla. Okay, a $1 trillion market. Do you hear these numbers? Sounds so ridiculous, right? I guess that's why they're called the Magnificent Seven. And as you can see, right, the numbers look pretty good. However, just like Apple, their top line is stagnating because when you think about it, an EV, an electric vehicle car, it's a consumer discretionary purchase, right? Just like an iPhone. You don't need to buy the newest and the latest iPhone if the budget gets tight and your wallet is looking a little light. People can live without buying the newest Tesla as well. And that's why I think their top line is suffering. But I think also going on behind the scenes and from the headlines is that there's a bunch of boycotts and protests happening against Elon Musk because they're like, dude, why is this guy so involved with the government? And especially with people that are government employees, they absolutely despise and hate Elon Musk because of his Doge committee and then the after effects of people losing their jobs from federal employees. Like, I'm from Northern Virginia, like Arlington and the Pentagon neighborhood. Half of those people probably work for the federal government, and I would argue probably like 5 or 6 or 7% of those people probably lost their jobs. They're probably disgruntled and they hate Elon Musk for life. Now, with all that said, I mean, their financials do look pretty good. Their free cash flow per share is $1.90, which I think is pretty impressive because most of the automakers, dude, they hardly have any free cash flow. But for Tesla, surprisingly, they do. And now here's the crazy thing, okay? By looking at just their CAGR, 46% year over year, you might be like, sign me up. But to that I say this, I think their stock price movement is just way too volatile for my taste. It's not my cup of tea. I prefer the slow and steady, reliable. See, I would rather go with, I don't know, Microsoft or Apple, knowing that I'm not gonna get the full 46%, but knowing that my money is slowly compounding. With Tesla, if you zoom out and you look at the past 5 years, dude, it's an absolute roller coaster ride. It goes up extremes and it goes down extremes. And this right here is the intrinsic valuation, and I reluctantly put a buy price, knowing full well that I would never buy into Tesla despite any price point. It's just a company where, for my risk profile, I just can't do. Okay, I admit it's a good business, good fundamentals. It's just something where I can't tolerate the swings of the highs and the lows. If you can't play with the fire, don't go in the fire. Knowing all of that, I'd rather just stay in my lane, slow and steady. I just can't do it, dude. And the next Mag 7 is gonna be Alphabet, also known as Google. So I think out of the Mag 7, Google is probably the only one that I believe is undervalued by a huge margin. But with that, I get it. There is so much negativity and headwinds surrounding this company, right? The anti-monopoly court cases, AI making Google search useless, and in the future, people are speculating that Google Chrome is going to be divested from their portfolio and it's no longer going to be the most dominant browser. So you either buy into the fear or you look past it because you see their financials and what the data says, and it's pretty darn pretty. So with that said, their revenue is growing 13% year over year. Free cash flow growth is 10% as well. And when we take a look at their intrinsic valuation, I think they should be around $230 to about $240 a share. I'll just go with $230. I'd rather play it safe than be too aggressive. And as of right now, Google trades for about $175, sometimes like $165. So I think they're really undervalued because even with a margin of safety baked in, that risk-adjusted stock price, it's $184 and they're well below that. So for me, it's a buy. I don't know about you, that's not financial advice, but I'm willing to believe in them. And the last Mag 7 stock is going to be Meta. Now, the funny thing about this company is a couple of years ago, I saw what was happening and I put $1,000 into them because they were going on this massive and brutal sell-off where they were going into the red day after day, week after week, where eventually they bottomed out at about like $88, $89 a share. And I remember thinking to myself like, dude, I'm either going to be really happy or I'm going to be wrong and be devastated. And sure enough, things panned out pretty amazing. And I remember every article, every headline, everybody was talking about how it's all over for Facebook, how Instagram was irrelevant, and everything else, right? The metaverse, Mark Zuckerberg has lost his mind. And I ignored it. I was like, wait, but on paper, things look pretty freaking good. And I just disagreed, and I just could not see eye to eye or resonate with all of that negativity. And I think that's how I also feel about Google. I think people are wrong about Google. The sad part of the story is once Meta rebounded to about $200 a share, I sold out of them because I was like, dude, they hit my price point and beyond. I don't think they're going to go up much further. If I just held on, dude, my $89 a share price point, cost basis, would have transformed into $700 a share. That's nearly 7xing my money. But hey, if you walk away in the green, you're still good to go. There's no reason to kick yourself in the head. And that's what I tell myself, and pretty happy with how it played out. But for as good of a company that I think Meta is as of right now, their valuation is just, it's too much. I think they're overpriced. Doesn't matter how you spin it or look at it or interpret it. If you didn't buy into them when they were like $150 or even like $200 a share, I don't want to be a doomsday kind of guy, but I think it's too late. I think the train station has already left. I think right now it's just not a good price. But with that said, if I had to absolutely develop a price point for them, then I think under $500 a share would be fair, but it's just a company that I wouldn't go near because it's just way too overvalued. Likewise with Tesla, it's the volatility. With Meta, it's just they're way too overvalued. Now let's go ahead and talk about the other popular stocks that are not a part of the Mag 7. The first of the bunch is going to be McDonald's. Now, I said a lot about McDonald's in my burger stocks ranking video. Go watch that video if you haven't. It's really insightful and it's entertaining. I will say this though, as a bottom line up front. I like this company, but not at their current valuations. Even though I think their operations are pretty much bulletproof, I just think at their current price point of like $305 or $310 a share, it's too much. I think McDonald's is a buy on the dip kind of company, just not dollar cost averaging at any willy-nilly price, if that makes sense. You want to buy it at a good discount. And that discount price for me is $265 a share or less. Anything under that $250 territory, sign me up. When we start talking about buying into McDonald's at $300 a share, I wouldn't do it. That's not financial advice, it's just I wouldn't do it. I need more of a margin of safety baked in. And the next one is going to be Disney, ticker symbol DIS. So despite what the bears think, I believe that Disney has so much more room for growth and they have so much potential. I think their future looks really, really bright. It's just they're injuring themselves, like trying to walk up a flight of stairs in the dark when you've had a glass or two of wine. It's just not a fun game. And the reason why I'm bullish about their potential is that entertainment is a business that is never not in demand. I think one thing about society and humans, the psychology of us is that we liked to be entertained. Even since the beginning of time, there were court jesters, there were actors and entertainers and beyond. With Disney, their ecosystem and their products, they're in the line of business of entertainment, and I like what they do. However, with that said, the business segment that I'm most bullish about in their portfolio is actually not entertainment, but rather it's their hotel, resort, and timeshares operation. The margin in that sector absolutely bonkers, and that's what I wish Disney would separate those two, because between the two options, I would rather invest into the hotel and resorts than Disney, the entertainment company. Even though I like all of it, that one I feel more bullish towards. Like if my bullish nipples are like a 9 out of 10 for that, for the entertainment side, it's like an 8 out of 10. So I'd rather go with the 9 out of 10 than the 8 out of 10. And as you take a look at their financials, I mean, on paper, it's just one of those things where it makes sense. It looks pretty darn good. It's just what they are doing right now. Remember what I said? They're just injuring themselves again and again. They keep doing the political agenda movies and TV shows to the point where it's alienating about 50% of the potential customer base. So I think if they were to cut that out, that would probably be the best business decision. But because it's such a polarizing company, it's not one that I would want to invest into right now. If I have proof in the pudding that they are going to stop it with the political agenda, then I wouldn't mind buying into Disney at under like $100 a share. But I think they're going to continue to shoot themselves in the foot. So just not interested. And of course, their economic mode is a 95. And the next one is going to be Target. Now, Target in 2025 is a C. And I talked about it in the ranking video. However, with that said, in the future, if they can make it past this whole boycott ordeal and how they have angered so many of their loyal customers from the past, they're probably my favorite retailer. If they can heal the wounds in the relationship between them and their customers. I actually like Target a lot more than Walmart, but a little less than Costco. I think if we're going to be talking about retailers, I think Costco is supreme, and I think Target is right below them. And you can call me delusional, but I'm willing to buy into Target if they dip below $89 a share again. I think right now they're like $99, maybe like $100 a share, but $89 and less, I think for me, I wouldn't mind buying into them. And then one thing that I do want to call out is when it comes to their economic moat, I have it as a 20 because 20 out of 100 because I really don't think they have an economic moat anymore. In the past, it used to be the shopping experience. However, when I went back to the US last month and I went to a Target multiple times because I prefer going to Target over Walmart, I noticed that almost 50% of their merchandise and inventory locked away on the shelves, and it's got to be annoying to flag down an employee every single time you need to get something. So not a fan of that. And also their financials are declining year over year, but it's nothing too crazy, right? If we're talking about their gross sales dropping by 0.7% year over year, we can go ahead and argue that it's pretty much flat. So even if they stay flat for one more year, I think getting them at 89 bucks a share, not the worst idea in the world for me. That's not financial advice, but for me, I wouldn't mind doing it. And the next popular company is going to be Boeing. Their market cap is $153 billion. How the heck do they have such a huge market cap for such a crappy company? But I guess it's because they print money. $69 billion of revenue, but is that revenue growing year over year? No, it's not. It went down by negative 9%. Now here's what I want to call out. When you think about the profitability, their net income, the bottom line, and their free cash flow, this means a negative. Negative $17 a share. Negative $18 a share. And when I looked into it, it's because they are negatively impacted due to the lawsuits of their planes falling out of the skies, labor strikes, CapEx, and delivery delays for some of their biggest birds like the 777, the 767, and the NASA Starliner. Because they're having human capital issues, they can't make do on their promises to their clients. So things are not looking too good for them. And the worst part about this company, I mean, there's a lot of bad things about Boeing, is that back in 2020, they cut and got rid of their dividend altogether. And you know how I feel about dividend cutters. On this channel, we are repulsed and we hate dividend cutters. So Boeing is a company that I would never, ever, ever want to invest into. As a matter of fact, off the top of my head, I can name 10 other defense contractors that I would buy before going anywhere near Boeing. It's like telling my children not to go near that house for Halloween because they're going to give you the worst type of candy like a Tootsie Roll. Maybe it's a great place to work for. I don't know. But from what I see as an outsider and as a stock, I think they're cursed. Their numbers look horrific, like getting hammered for the first time and vomiting everywhere. It's just a disgusting picture. I mean, look at this. Their free cash flow per share growth year over year, negative 350%. That is atrocious. So I'm confused as to how the heck did they pull off a 7.7% CAGR for the past 20 years. It doesn't make sense to me in my pea brain. So in the spirit of this video, I did go ahead and put a buy price at about $99 a share, but I will say this, I do not trust them as an investment, nor would I want to buy them. So even though it says my buy price, I would never ever want to buy Boeing. I'm serious. I do not like this company. And the next company is Uber. And I think at first glimpse, their financials look pretty good year over year. However, it's only recently that Uber has become profitable. My only thing is, when it comes to Uber, I'm just more bullish towards Waymo and Tesla than I am towards Uber. And you know that I would never invest into Tesla, but I would rather invest into Tesla than Uber. Because here's my train of thought. Once autonomous driving technology gets better, and it's getting better by the day, to the point where it's going to be readily available in the near future, people will just have their cars go out and provide Uber rides via Waymo or Tesla. They're not going to utilize Uber. And Uber does not have that technology. Right? The R&D and innovation is happening for Google and Tesla because they're using their capital to make that happen, whereas Uber is using physical drivers as 1099 employees to do the magic. Now, I could absolutely be wrong, but that's just my thoughts. And on a personal level, I guess I don't want to invest into Uber because I use Lyft instead of Uber. I've always had a more pleasant experience with Lyft than with Uber. So that's another reason why I would not buy into Uber. No matter how good or undervalued their stock price may seem, it's just not for me. So in the spirit of this video, my buy price would be under 40 bucks a share, but I wouldn't want to buy into them. Next company is Costco. It's one of the handful of companies that defy all logic and valuation metrics. It's hard to put a price tag on this one because they trade at such a premium with all of the boomers that are investing their money into them, regardless of their performance, valuation, or financials. This retailer has a PE ratio of a 60. At the time of filming this video, a 60. However, in a perfect world, if their trading multiple were ever to become a 22, based on their current earnings of about $17.66 a share, then a price at around $400 or less would be ideal. Costco at a PE ratio of 22 sounds a lot more fair to me than a PE ratio of a 60. Because in my opinion, if you're going to have a PE ratio of a 60, your revenue growth has to be a lot better than 6% year over year. Your free cash flow growth has to be better than an 8%. Because when we think about the Mag 7, like Microsoft, Apple, Google, even their trading multiples are not at the levels of a 60. For crying out loud. Now, please don't get me confused. I'm not bearish towards Costco. I actually love their business model, and I think their future looks really fantastic. It's just that I do not agree with their valuation. The value investing side of my brain just melts and has a breakdown at the fact that people are willing to buy Costco at $1,000 a share. Because to me, I think their intrinsic valuation is 750 bucks. So for someone to overpay for Costco by $250, it just makes my head explode. And I don't agree with that. A great business and a great stock, just way too overpriced. The next company is Domino's, ticker symbol DPZ. Now, as a guy that invests in Papa John's and Domino's, I gotta say, Domino's is pound for pound the best in class in all segments of the pizza industry. Their financials, their economic moat, and the taste of the pizza itself, it puts them into the S tier. Is it any surprise? I mean, look at it. Look at your screen right now. Their free cash flow per share is $16. How much did they pay out in dividends per share? Less than $7. That is fantastic and phenomenal. But with that said, very similar to McDonald's, I think Domino's is a buy in the dip kind of stock because you can buy and hold this one for a very, very long time. At its current valuations, I just don't think it's a good bargain or a good deal. Because my personal buy price is whenever they go on the dip to about like $3.40, $3.30 a share, that's when I usually pick up one share. Something weird about me is I usually buy my stocks in a ratio of 1, 5, or 10. That's the increments that I like to do my buying. And since Domino's is like $400 a share, I usually only get like one at a time. As a dividend growth investor, I think the best part about Domino's is their dividend growth rate, just shy of 20%. I think that's really romantic and sweet. Thank you, Domino's. And last but not least, we have UnitedHealth Group. As of right now, this is what's really crazy. You know the market is overreacting because when you look at their price to sales ratio, I like that one better than the PE. But anyways, they're posting $410 billion of revenue, correct? Look at their market cap, $288 billion. For a company that posts numbers like they do, to have their revenue be bigger than their market cap is absolutely bonkers. Now, between you and me, I said a lot about UnitedHealth Group about a week ago because I made a dedicated analysis and a deep dive video for them. It's a company that I am willing to buy into, but it has to be the right price. And I think that's below $2.99 a share or less. A B plus overall, the UnitedHealth Group. So if you're curious to know my thoughts and opinions about this company, do watch that video. It is worth your time. And that just about wraps it up. Let's review it, right? If we take a look at the companies all together in congregate, the economic moat, the best one is Amazon by far, closely followed by Meta and Disney. I think the worst economic moat that we have out of these companies is Target at a 20. So my question to you is, which ones do you own in your portfolio? And do you agree or disagree with my takes? Let me know. I'm open-minded and I'm always willing to change my opinion if I am wrong. And with that said, if you appreciate this type of content, would you consider becoming a part of the Patreon family? If you want to hear my full pitch as to why Patreon makes sense for you, then please watch the video that I have included into the pinned comment of this video. Anyways, if you choose not to, it's okay. I still love you guys. Stay safe. Good luck in the stock market, and I will talk to you very soon. Peace.